Good morning. As Helena said, my name is Carlos, and I'm a reporter with the Energy Wire team at E&E News and Politico, based in Washington, D.C. Today, we're here for the panel discussion, Stranded Assets and the Implications of Net Zero 2050 for Upstream Oil and Gas, to talk about the ambitious target of holding global warming to 1.5 degrees Celsius and what that means for stranded asset risk in the global oil and gas sector. According to Carbon Tracker, stranded assets are those that turn out to be less than expected as a result of changes associated with the energy transition. Released earlier this month, Carbon Tracker's report, Adapt to Survive: Why Oil Companies Must Plan for Net Zero and Avoid Stranded Assets, notes that the International Energy Agency's Net Zero by 2050 scenario calls for a halt to all investment in new oil and gas fields, meaning that oil and gas companies must plan for major declines in production as existing sites wind down without being replaced. Here with us today to talk about the report are its co-authors, Axel Dahlmann and Mike Coffin. Axel joined Carbon Tracker in 2020 and is an associate analyst. Mike is the head of oil, gas, and mining and joined Carbon Tracker in 2019. After they discuss the report, we'll get some thoughts on the analysis from our panelists. Let's introduce them. Here today, we have Andrew Collins, Director of ESG and Responsible Investing for the San Francisco Employees Retirement System, a public pension serving over 70,000 active and retired city and county of San Francisco workers. We're also joined by Tracy Cameron, Senior Manager of Corporate Climate Engagement at Ceres, a nonprofit with the goal of transforming the economy to build a just and sustainable future for people and the planet. Rounding out our panel is Bjorn Otto Sverdrup, Executive Chairman of the Oil and Gas Climate Initiative, a CEO-led initiative that aims to accelerate the industry response to climate change. For now, I'd like to turn things back over to Mike.
Great, Carlos, thanks very much for the introduction. So what I'd like to do now in the next 10 minutes is give a really high-level summary of the report we put out 2 weeks ago, Adapt to Survive: Why Oil Companies Must Plan for Net Zero and Avoid Stranded Assets. So, as Carlos says, this is a report that's co-authored by myself and my colleague Axel Dahlmann in the oil and gas mining team here at Carbon Tracker. Now, this is the fifth report the fifth annual report in our 2 Degrees of Separation series, looking at stranded asset risk in upstream oil and gas. This year, one of the key update to this year's analysis is that we've incorporated some of the implications of the IEA's Net Zero 2050 scenario, which is a 1.5 degree scenario. And what we look at here is the, as I say, the implications for oil, gas, and mining companies, and then, of course, this core thesis around stranded asset risk for those upstream oil and gas companies. So the key takeaways from today's talk are that in a 1.5 degrees C world with net zero 2050 means no new oil and gas projects. That message was very clear from the IEA earlier this year. Production from the existing assets falls rapidly. Now, and that has significant implications for oil and gas company production. The transition to a low carbon world means fossil fuel demand falls. So even in other scenarios, with a higher temperature outcome than 1.5 degrees C, other scenarios, some of which are Paris aligned with the goals of the Paris Agreement, means there's still significant stranded asset risk for oil and gas companies. Ultimately, investors need to ensure that the companies that they invest in change now, adapt their business models to protect both the climate, but crucially also the investments and the underlying investments. So 1.5 degrees C means no new projects. And net zero 2050 is becoming a widely accepted benchmark, along with that 1.5 degrees C. And there are a number of scenarios that do this. The IEA, the International Energy Agency, published their net zero emissions 2050 scenario, and they were clear. That meant no new oil and gas projects. And in the first part of the report, we looked at what is the implication for this at the industry level, but also at the company level. And I'll share now some of those highest level themes that we get out of that. So firstly, to reiterate, production falls rapidly from existing fields. And we see for the listed companies, so we look at all oil and gas companies in our analysis, presenting results for the top 40 listed companies. And we see that more than half of them see production drops of over 50% by the 2030s. Now, this is looking at oil and gas on an MMBOE basis. And you can see in the graph on the right, and I won't talk to the companies in detail, of course, please do look at our report to look at that. But what you can see is a baseline, the baseline at 100% of 2021 production levels in MMBOE. Only Saudi Aramco will actually see production in excess of that level when looking at the future production from already sanctioned assets. So to reiterate, we are looking here at what is that future production from only those projects that exist today, assuming that no further projects are sanctioned, as is clear from the International Energy Agency's scenario, that if we are to achieve 1.5 degrees, that's ultimately what we must do. Though future projects that have not been developed to date must stay in the ground as unburnable carbon to reach that temperature outcome. And you can see on the right, we've coloured those companies, those 40 companies, but broadly by theme. So you have there the majors and the integrated companies in red, and some of the shale-focused companies in yellow. And you can see those yellow shale-focused companies cluster towards the bottom of that chart, with some showing declines into the 2030s of over 80% versus 2021 production levels. Clearly, this production level will have a significant impact on both revenue and cash flow for these companies. And investors really must be aware of the differential risks of these production declines that face these companies. Ultimately, the production declines are a function of the company's underlying project portfolios. So Paris-aligned pathways or other Paris-aligned pathways also imply rapidly falling demand. So it's not just 1.5 degree scenarios that fundamentally challenge the industry. For example, the Sustainable Development Scenario, also from the International Energy Agency, which is a 1.65 degrees C scenario, also shows the need for rapid decline for us to be able to achieve that temperature goal. In our work, we have used the SDS as a Paris-aligned scenario, so well below 2 degrees, and aiming, rather than aiming necessarily for that full goal of the Paris Agreement of a decline of 1.5 degrees C by 2100. If I draw your attention to the chart on the right, you see the future supply from already sanctioned oil and gas projects is shown in grey at the back. On top of this, we're looking at the scenarios. So you have the NZE scenario, so the net zero emissions by 2050 scenario that we just looked at from the IEA. That's the 1.5 degrees C scenario. We also have on here the Sustainable Development Scenario, showed us the light blue line, and then at the top of this blue wedge. And then we also have STEPS, the Stated Policy Scenario from the IEA. That's a 2.7 degrees C warming outcome around 2100. And we see that broadly as a business as usual proxy. So if you look at the sanctioning decisions from the oil and gas companies over the past few years, we see that companies are broadly sanctioning projects broadly in line with that trajectory. Now, clearly there is variation between companies, and we'll come on to some of the differences there. But broadly as an industry average, we see that as an appropriate business as usual proxy. So just staying on that slide for a second more, what we can see from here is that our analysis, and we take these International Energy Agency scenarios and compare them to supply for using data from Rystad Energy. Now you can see here that the NZE scenario shows oil demand well below the future supply from existing projects, corroborating the IEA's results that no new oil and gas projects are needed. If we look at the Sustainable Development Scenario, there's only a very small supply gap, so shown in the shaded blue area, with dotted blue area, I should add, and a far smaller supply gap than shown in the orange wedge here. So business as usual planning along STEPS creates significant stranded asset risk. So if you're sanctioning assets expecting a growing demand, but actually it's falling as under the Sustainable Development Scenario, there is a stranded asset risk. And of course, there's a number of reasons why the world could, and we hope it will, go on a low carbon scenario, such as the Sustainable Development Scenario. This could be out competition by renewables, it could be policy action, or it can be changing societal and investor sentiment. Each of these, and likely a combination of all, will ultimately impact oil demand. And this is what gives rise to stranded assets. So we use a least cost approach to determining stranded assets. We look at all oil and gas projects globally, and we define a cost curve. So on the x-axis here is cumulative oil field liquid supply. And then what we look at, we rank those projects in cost order, taking an economically rational approach. We focus on unsanctioned project options only. So our modelling assumes that existing assets continue for their useful lives, or their planned lives, I should say, but we look at sanction of new projects. And so if we look on the x-axis at demand under SDS, so the blue arrow, there's very limited demand. This is the aggregate over the next 2 decades of demand. And we see that very few projects are needed. Under steps, far more projects would go ahead. So if companies are sanctioning projects in this middle sector, between the blue and the orange vertical lines, those are at risk of stranded assets. And what we do here, I should really stress that it's the relative positioning of projects on this curve that matters. The absolute values of the break-even prices on the y-axis clearly will change in response to commodity prices and other things. However, the relative positioning of these projects will stay broadly similar. So what do we then do? We can then aggregate these projects at the company level to look at the stranded asset risk by companies as well. But what we also can do is just look at some of the headline numbers, and we see that planning for business as usual risks $1 trillion of capital to 2030. Most project options are not needed in a low carbon scenario, the SDS. Of course, none of them are needed in that 1.5 degree scenario, the IEA's net zero scenario. So the blue bars here, and this is shown by project theme, show that only show the projects that fall inside the sustainable development scenario. Those projects that fall outside the sustainable development scenario, but inside business as usual steps, are shown in yellow. And it's the aggregate of those yellow bars that totals $1 trillion of capex over the coming decade. Of course, there are also further projects that fall even higher cost projects, shown in red, that fall outside even that 2.7 degree scenario. And some of those projects are still on companies' radars as potentially being planned in the coming year. So I'll reiterate, companies' stranded asset risk ultimately reflects the portfolio of their project options. And we encourage you to read the report in more detail to see a breakdown of those between individual companies. Broadly, we see an alignment between stranded asset risk or exposure to these transition risks by company and the companies that are more progressive in terms of their emissions goals and transitioning their business away from oil and gas. So we see a correlation between the two. And then finally, for investor considerations, if companies claim 1.5 degrees C and a net zero 2050 alignment, how are they sanctioning new projects? How are those companies justifying those new sanctions to investors? And we urge investors to press companies to reveal why they feel new sanctions are aligned with a 1.5 degrees C scenario. Clearly, there's a growing investor sentiment around aligning investment portfolios and lending portfolios, for example, for banks, around 1.5 degrees C. Preparing for a low carbon world is critical, and companies must show how those new projects are compatible with Paris. And of course, company plans can take different forms. They can take, companies could adopt a wind down model, companies could look to reinvest capital elsewhere, and that could be in renewable energy, but it could also be in many other sectors too. Ultimately, it's key that companies reframe their businesses away from oil and gas, and they do have many options of what they could then go and do. Again, importantly, get investors engaged with them on this, particularly around understanding the resilience of their portfolio, emissions targets, goals or ambitions, remuneration policy. So, for example, not rewarding growth in oil and gas production volume, which most oil and gas companies continue to do, which we have written out. And again, of course, looking at impairment price assumptions and oil and gas price forecasts. So I'll just leave you again with my summary remarks here. 1.5 degrees C scenario by 2050 and net zero by 2050 means no new oil and gas projects, and production falls rapidly. Transition to the low carbon world means fossil fuel demand falls, and there's significant stranded asset risk for oil and gas companies and the industry as a whole, and companies specifically. And there are significant differences, and it's the relative difference of risk exposure that we think is important for investors. And we do encourage you to read the report in detail and see the results by company and the relative differences. Ultimately, investors need to ensure these companies change now to protect both the climate and their investments. Thank you.
Thanks, Mike, for that great overview of the report. And be sure to read it, you all, if you haven't yet. First, to get reaction on the report and its findings, we're going to turn to Tracy Cameron at Ceres. Tracy, take it away.
Thanks, Carlos. So thank you, Mike. A great report, and one in a series of many. Carbon Tracker reports have been a terrific tool for investors. As Carlos mentioned, I work for Ceres. We're a nonprofit sustainability organization, and we also are very involved in Climate Action 100, which is a global initiative that's got over 600 investors with 55 trillion in assets under management, that we coordinate the activities for North America series. So a significant number of investable dollars across the globe, and these investors are all very committed to looking at their portfolios for three key reasons when they engage these companies that they've committed to engage. And they're asking companies to have governance over climate risk. They're asking companies to have specific action on greenhouse gas emissions and be very clear about those actions. And then also to be very forthcoming with disclosure in TCFD aligned recommendations. So it's very specific asks for companies, but we think that it's incredibly important. And the work that Carbon Tracker has done with this report and feeding some of the analysis that's used by Climate Action 100 is really fundamental, because it does give that relative value. It allows investors to see where on the spectrum companies will fare in a future world when we are pretty certain there are going to be fewer players available for a very smaller pie that we expect to see. So this is very helpful because there's a lot of complexity. There's complexity on the company side, as the report shows. Every company has a different profile. They've got different cost structure, different resources, and investors similarly are very different. They have different mandates. They have mandates from stakeholders who are pressing them to divest. They have made numerous commitments in the last 18 months to have net zero portfolios themselves. And some investors are passive investors, and they can't act through anything other than engagement and their voting actions. So we're grappling with all that, and the Carbon Tracker analysis is just a great tool for investors to use as they undertake those engagements. I'll stop there and pass it to Andrew, perhaps.
Yep, that's right. Thanks, Tracy.
Thanks, Tracy. Thanks, Carlos and Mike for having me on here. As Carlos said in the intro, I'm ESG director at the San Francisco City Pension. We manage about 36 billion in assets. We are a net zero, or have the ambition to be a net zero asset owner by 2050. We announced that in March of 2020, but really began working with Carbon Tracker in 2018 as we thought about our oil and gas exposure in our public markets portfolios, and really came at this this challenge of investing in this space with the belief that there is an opportunity for companies to transition, oil and gas companies to transition to a low carbon world. The pathways may be narrowing, but there should be pathways. At the same time, there may be companies that are not able to navigate that transition and have unmitigated risk for us as investors. And so we developed a quantitative framework in 2018 that really sought to analyze just that, the relative positioning of oil and gas companies, and guide us in thinking about what we call prudently phased divestment of certain companies, and then prioritizing companies on a watch list to engage with to understand how they're planning to transition their businesses to the low carbon economy. The Carbon Tracker data, company level data around future capex is a core pillar of our framework. It began in 2018 with 4 parts. One was looking at the Carbon Tracker data, what type of projects are in the pipeline and how healthy are those from a cost perspective. We also looked at operational efficiency, the actual scope 1 and scope 2 carbon emissions of companies. We pulled in data from Influence Map to look at political spending, lobbying activities of companies to see if they were lobbying for or against progressive climate legislation. And then we looked at the financial health of companies. And we looked at some markers to understand what is the profitability of each company, what is the balance sheet strength, to really understand if you are able to fund the transition to a low carbon economy, or are you well positioned to do so or not. And so we've revisited this framework each year. We're underway now that this report has been released to do the 2021 refresh. Our addition to our framework this year has been to build in a new data set around climate targets from oil and gas companies, as they've made more statements around their own goals to be net zero by 2050, different decarbonization timelines. And so that's going to be an important addition to see how those companies that have made those statements, that's being reflected in those other areas around their own carbon emissions, their reserve health. What we've observed reading the report this year, I think, has been that very few companies have improved in their profile with respect to the percentage of their future projects that are viable in a low carbon scenario. Many companies have worsened. We really focus on the worst quartile of companies. And in 2020, that worst quartile had 45% or more of their CapEx at risk. Now that worst quartile is 60% or more of their CapEx at risk. We've also seen some consolidation amongst particularly companies that we have actually put on a restricted list for divestment. So we've seen a company like Parsley Energy be acquired. We've seen WPX merge with Devon Energy. And we've even seen Diamondback, a company on our restricted list, acquire QEP, another company on our restricted list. So this is going to be a big focus of our engagement activities going forward, is how do the new profile of merged and acquired businesses reflect on the new entity with respect to their low carbon transition plan. So a lot of work to do in terms of our analysis, our engagement activities, but another great report from Carbon Tracker that's helping us navigate our climate transition investing process.
Thank you, Andrew. And now we're going to turn to Bjorn.
Thanks, Carlos, and thanks to Mike and Andrew and Tracy, and thanks to Carbon Tracker in particular for inviting me to be part of this event. Could I start by congratulating Carbon Tracker, because I think over the last years you've been played a very important role in spreading the understandings related to the significance of the carbon budget idea. I think also you've been very important to show how companies could find ways of embedding climate dimension into its decision making. And also I think you helped provide more insight into how to understand the resilience around this industry, or what does resilient company look like, or future fit company look like. So congrats to that. And of course, the reports you're presenting are important parts of the picture, but I don't think it's the full and complete picture. So now I'm the chair of OGCI, so I'm, like it or not, but I'm constrained from being able to comment upon future production plans from the companies. This is from competition law, and it kind of follows as a natural consequence, given that OGCI is a group of companies led by the CEOs of 12 of the largest oil and gas companies in the world. So we're not able to discuss future production or future project sanctioning. But I think if one high level observation to me reading the report was still that, you know, most of the companies on the list, they have the opportunity to shape the future of their own companies. And I think that's in itself a very important insight. And then the other thing that struck me when I was reading the report was that the report does not talk about will society be able to reduce quickly. So yes, this report is looking at the supply side, but isn't it important to look for lasting change, to also look at the demand side? And the question is, how could we accelerate decarbonization efforts in other industries, making the world able to use less coal and oil over time to ensure that emissions from fossil fuels are going down. And I think, you know, unless we ask that question, we need to be able to address the question that, is the world better off if IOCs in the future shouldn't be the ones producing oil and gas? Because, you know, regardless how you're looking at it, at least some of the, you know, the OGCI members at least are more transparent, are more explicit on the climate commitments, and have a clearer governance compared to most other companies in the oil and gas industry. So oil and gas companies are not equal, they differ. And I think the OGCI companies at least are trying to make an effort to both accelerate its own decarbonization and to help accelerate the decarbonization of society. So on Monday, actually, we announced a new strategy. And here we both reiterate the support to Paris Agreement. We recognize the significance of urgent actions needed, and we recognize that climate emissions from oil and gas also needs to decline. But we're pointing to two fundamental challenges that this industry can play. First, we need to improve the existing system, energy system of the world. By that, it's what Andrew talked about now. How could we, as soon as possible, bring the emissions from the oil and gas industry in itself to net zero? Some of you may say it's not significant, but you know, actually that's 1 gigaton inside those 12 companies alone. And if you include the entire oil and gas industry worldwide, that's 4 gigaton, basically 10% of the world's total emissions. The second question, big question, is to what extent or how could we look at this industry and try finding ways to unlock the capital, the competence, the engineering insight, the execution capacity of this industry to help find decarbonization solutions to other industries. Key questions would be, could we accelerate the development of the much needed carbon capture and storage industry? Could we emission and become, and you know, move faster towards a hydrogen economy? How could we invest more into the future building blocks of the new energy system that all of us would need? So I'm not saying this, you know, as a final comment, I'm not saying this that how we allocate capital in the future is unimportant. On the contrary, I believe it's key. But I think it's one of the questions we need to address, but we also need to address how could we really contribute to help the customers change its energy needs. So thanks.
Thanks, Bjorn, for sharing those thoughts. Now we're opening up to a Q&A. I see that there's already questions coming into our chat box. One place that I think I'd like to start, the report talks about the importance of investors continuing to pressure companies for more serious transition planning. And I think it might be good for us to talk about the main tools that investors have to do that and exert that pressure, and how are we already seeing that happen now?
Sure, I can start, and maybe Tracy, you can jump in. Great question, Carlos. I mean, I think there's a range of tools that investors have really to understand climate transition planning, and it starts with information, you know, coming from companies directly themselves. So their disclosures that they're making around their climate transition plans. This, you know, can be in the form of an ESG report. It can be in more and more you're seeing climate-specific transition reports coming from companies. That's, you're right, an initial starting point. Direct dialogue is essential in this arena, and with the help of Ceres and other coordinators of the Climate Action 100 Plus initiative. That's really the core pillar of that initiative, coming into its fourth year here, of sitting down directly with the management and boards of directors of oil and gas companies, amongst other of the largest carbon emitters, and understanding and having a dialogue around those climate transition plans. That dialogue, right, can be escalated through shareholder proposals to get additional information. And then I think, even you're seeing now, and I think you'll see this more and more, Exxon this past year is a case in point where there was actually action against specific directors of the company around, a core element of that was climate transition planning. There's other votes from investors against directors of companies around perceived failures to plan and manage the company for the climate transition. So range of tools, I think, with different degrees of being collaborative versus being able to escalate those works. And then I think the last piece is external data sets, like the work that Carbon Tracker and other researchers are doing. Really need to bring that in. Many emerging data sets that give a perspective outside of what the company itself is saying, to really get a sense of is a company truly planning for a climate transition or not.
Just add that I think you got a sense from what Andrew just said that it's a lot of work to dig through all the different reports and get that information, and hopefully we'll get to a better place. Climate Action 100 spent probably a year and a half, 2 years devising a benchmark to evaluate the 167 companies that are on the engagement list for Climate Action 100. And they looked at 9 indicators, and that'll be expanded to 10. And Carbon Tracker was really helpful in evaluating some of those indicators, but it's a very time-consuming, resource-intensive process. But they kind of aggregate a lot of information and try to assess companies where they are now, and then assess them over time on progress in meeting the goals of the Paris Agreement. But a lot of work. And one thing we're very hopeful to see in the US is more regulation on climate disclosure from the SEC. They'll be releasing something later this year, towards the end of the year, that will clarify and give opportunity to comment on how climate disclosure should be embedded in a lot of reports. And it's something that investors are looking at very closely, a lot of other organizations, but really get the right information, get it into a format that's comparable and that we can, pull and really make more usable.
Thanks, Tracy. Thanks, Andrew. The next question, we're getting a bunch of questions about earlier this week, Shell agreed to sell its position in the Permian Basin, one of the most prolific U.S. oil fields, to ConocoPhillips for about $9.5 billion. And so maybe we could start with Bjorn and then maybe Mike. To what extent is this deal about Shell trying to lower its own emissions footprint? And what does that mean for Conoco, which Carbon Tracker said in its report that it's one of the oil majors most exposed? So maybe we start with Bjorn.
I think that's actually a very interesting question. So is it a good climate action if you're disposing of some assets that you don't believe are future fit for your company, if you're selling it? One analog could be, if you're buying yourself an electric car, could you still sell your old petrol car secondhand, or do you need to drive it off to have it chopped up in order for that to be a sound climate action? I actually believe that, some of the things that Tracy talked about on the importance of TCFD, that has changed a bit the way we can think around this, because environmental reporting used to be about how your company or your own actions are impacting the environment. With TCFD, the arrow changed a bit because it said, so how will the changing environment, the climate, impact your company? So I think actually it is a healthy proposition. Portfolio adjustments should be seen as a means of for companies to be allowed to shape their portfolio and, you know, with that kind of bring the climate risk related to its own business or the footprint related to its own business down. And I think the transition will happen much slower if you're not allowing companies to dispose of those assets. But having said that, it shows again, you know, a handful of companies or a leading group of companies are more transparent than others. So the overall, the broad question for transparency, it needs to be spread through all industries and all companies, basically. Otherwise, you will see kind of a carbon leakages.
Yeah, thanks. I mean, I think just to comment on that, if companies are divesting their assets to other companies, be that through whether that's through shareholder pressure or the companies themselves recognizing the transition risks they face and looking to reframe that company's strategy away from oil and gas, which we're saying that actually is the potentially prudent thing to be doing in the face of the energy transition. Then I think we need to look at the two separate impacts. I mean, one is the impact of reducing emissions by from the environmental perspective. So what is the impact on reducing emissions of this asset sale? And secondly, there is the piece from the investor angle, which is ultimately by Shell selling out of those assets or divesting those assets, that is reducing Shell's exposure to transit asset risk and stranded asset risk, and ultimately Shell's underlying investors reducing their exposure. I think coming back to so I think that's the first side. But on the environmental side and the emissions, ultimately, the fewer investors that are prepared to continue to invest or be part of new project sanctions as awareness of the physical impacts of climate change take place, the more investors that are not prepared to invest will force more companies to not sanction new assets, which ultimately will ultimately rises the cost of capital for those projects, and fewer projects will become sanctioned. I think which will in time certainly have a benefit of fewer projects staying in the ground, so fewer absolute emissions will be released to the atmosphere. I think sort of just to respond there slightly to the analogy around cars, yes, ultimately if you have a car and it's reached the end of its life for its current owner, you have a choice. Do you buy a new one or do you buy an EV? Now clearly, if someone's buying an electric vehicle as opposed to internal combustion engine vehicle, that is a positive thing for the climate. And by selling their existing ICE, then you wouldn't be saying, hey, ultimately you're not building a new internal combustion engine with all the emissions that go into building a new one. So yes, in that example, but that works. But what of course you're not doing with renewables pricing coming down and the cost of electric vehicles coming down, that is impacting the sales of internal combustion vehicles, which in turn will be reducing the demand for fossil fuels, and ultimately that brings us back to the transition risk and the risk of companies ultimately sanctioning assets, expecting 30 years of production from their upstream oil and gas assets when the demand ultimately fails to materialize. And I think the key thing I'd say here is that policy action can be very slow, and societal action and change can be very slow initially, and then can suddenly change very rapidly, and at the point the pace of change of the demand side outstrips the natural decline of existing assets on the supply side, is when the companies will be in real problem. And what we're saying is investors need to be aware of those risks now and plan for it, rather than sanctioning assets based on 30-year time horizon.
Thanks, Mike and Bjorn. Tracy, you had mentioned that one of the things that you're looking at is specific action on greenhouse gases from companies. Meanwhile, Andrew, you had said that very few companies have improved from what you're looking at. Can you talk about, maybe we'll start with you, Andrew, the companies that have improved and what they've done, and maybe Tracy to follow up there, what are the specific actions that you are looking at to combat greenhouse gases?
Thanks, Carl. So yeah, I can pass to Tracy perhaps, and just point of clarification is that our analysis, and we will need to rerun our carbon footprint analysis, the operational emissions analysis this year. That analysis in the past has actually shown that oil and gas companies have generally improved over time in terms of their own direct energy efficiency. So much more work to do there. I think we're pushing for more aggressive goals, and particularly goals around methane emissions and proper measurement of those methane emissions in the operational profile of companies, and more ambitious commitments around reducing those and other operational emissions. But the point I made, Carlos, in terms of worsening positioning was with respect to Carbon Tracker's analysis of the reserve, future project and stranded capex at risk was a data point within our framework that has worsened. Tracy, any other comments around operational emissions?
Well, I just think it's important to highlight methane, as you mentioned. I think the guidance now is 75% reduction in methane by 2030, and that's something that's actionable, tangible now. Companies can do. There are methane regulations expected, I think, in the middle of October in the U.S. Draft rules. We would love every oil and gas company to support those, and it's always surprising to me that there's not more company action on policy like that, because it seems like if you had a level playing field, they're the good operators, and many of these larger companies are very good operators, are immediately at a competitive advantage. So, action on methane would be a very quick thing. Investors are very focused on capital spending. How are those project dollars being spent that align with Paris going forward? So I think those are probably the two areas that investors are thinking about most closely, and really, action on methane in the near term is something that every company can do. So.
We're getting one question, maybe we'll direct this one to you, Mike. When the IEA is talking about no new projects, the question is, does that open the door for litigation against companies that do try and sanction new projects at this point?
That's an interesting question, and I suppose one which is, I'll be honest, a bit outside of our expertise, but I think we can certainly comment to it. I'd probably say yes, there is. I think you will see increased litigation in the oil and gas space in sort of both ways round. One from obviously from environmental movements and others pursuing legal action against the companies themselves. And then clearly we saw a legal case earlier this year with Shell in the Netherlands, where it was their emissions intensity climate goals were challenged, and the court ruled that actually ultimately to take climate action they need to use an absolute approach to emissions reduction, including their end-use emissions, which ultimately will effectively requires them or mandates them to reduce production on an absolute level, because ultimately there's a very direct link between production volume and emissions from their end combustion included within that scope 1, 2, 3 target. As I say, and clearly we're seeing increased litigation from that side, and we expect that to increase in the future. In terms of the piece here around the litigation from companies back to states around policy action, then yes, that is something that I speaking personally, would probably expect to see increase. But I can't really comment on the validity of those claims and what society should do in response. So I think I'll just sort of leave it there. I don't know if any other members of the panel have anything to say on that question.
The only thing I would add, I think in general, and I've seen a couple questions about the divestiture and acquisition of specific assets. We've seen different M&A activity occur, and I think it's really contingent on us as investors, and not just ESG investors, but all investors, to really press company management around those decisions and how they've actually integrated climate scenario and climate planning into the price that they've paid and their plans to integrate those assets into their portfolio. Many companies do say that they do use a range of different price scenarios. Some companies use an internal carbon cost that has a variety of ranges to stress test their existing portfolio, but also potential acquisition targets. And I think we need that conversation, needs to be, furthered in light of the new IEA report and new expectations around the pace of decarbonization and projections around, what decline in oil and gas prices could look like in different climate scenarios. And, whether that gets into litigation or not, can't really speculate, but it should affect investors' decision to understand if this was a prudent use of capital to acquire those resources or not.
And then another question, thanks for that, Andrew, that we're getting is about whether a more precise definition of net zero is needed. And, I also would like to know, when investors are looking at companies' net zero targets, how important is it that they're looking beyond operational emissions and scope 1 and 2, and looking beyond to emissions that are created when consumers are using a product. So maybe could we start with Mike and then kind of go around the room?
Yeah, that's a really important question. I think I'll sort of answer that in two parts. I think the first point is exactly that. What does net zero mean? There are lots of claims of net zero by companies, by investors, by investment products. But what does it mean? Ultimately, as we continue to have put CO2 into the atmosphere, the planet will continue to warm at the very fundamental level. So we need to reach a point of net zero emissions to halt the warming. So until we reach that point, we'll continue to warm. So what matters is the aggregate emissions between today and the point we reach net zero. Well, that will determine the warming outcome. So for any warming outcome, to turn that around, any warming outcome, there is a carbon budget. So for example, 1.5 degrees, it's around 400 gigatons of CO2, and we produce about 41.5 gigatons of CO2 annually. So that's 10 years to get to 1.5 degrees at current emissions, and then it would have to just stop. So getting to net zero, say net zero 2050, that's clearly a good goal, but how we get there is what's critical to determining the warming outcome, which is why any claim of net zero needs to be accompanied by a temperature goal, and that inherently links to a scenario and thus a pathway for emissions and sectors on the way there. So I think that's a really important point, so sorry to belabor that. And the second part around what does net zero mean in terms of oil and gas company goals. We've actually written a series of reports on this called the Absolute Impact Series. The latest one, Absolute Impact 2021, which was released in the spring this year. And in that, we've refined our 3 hallmarks of Paris compliance. So that is that company targets must cover scope 1, 2, and 3 emissions. So crucially, the 85% of emissions that result from end combustion of fossil fuels. They must cover targets must be on an absolute basis, not an intensity basis, i.e. companies cannot just add renewables to their portfolio, reducing their emissions intensity while still having the same absolute level of emissions. And then finally we need to cover all of a company's activities, not just on an operated basis, but also where they have an equity stake. So that's crucial. And then to link through to the pathway towards net zero, to ultimately to link to that temperature goal, rather than just being net zero, it's crucial that we have interim targets. And I think there's growing consensus around interim targets on an absolute basis to 2030. So it's really important, we think, both for the climate, but also to align emissions goals. Effectively, they're a proxy for company transition plans, i.e., if companies are reducing in an absolute sense their scope 1, 2, and 3 emissions, ultimately that is because they are reducing their production volume, i.e. moving away from oil and gas. Aligning corporate strategy with emissions goals and a move away from oil and gas is ultimately reducing transition risk for investors, as well, of course, helping us achieve global climate goals and limiting temperature rise. Anyway, sorry, I'll pause there.
Yeah, I'd be happy to answer that. I think the question on net zero, how exactly you define it, I think we need to act quickly. And so the definition is less important unless you're talking about negative emissions technology, CCS, and how that plays in. And the story on that is not written yet, and we don't really know. But I think the more information we have in terms of how companies are planning to use that in their strategies, what investments they're making to get us there, what are the trade-offs? Those are the questions that I think we need to answer now before we count on those technologies. And it's very likely that will play a part in 2050, but we don't know the extent of that. And the things we can do now that get us on track by 2030 are the ones that are concrete, and that it would be good for companies to lay out clear strategies. In terms of scope 3, I like what Bjorn said earlier in terms of it's a society problem. It's very difficult for an oil and gas company to look at scope 3 and say, I have an impact on that. But they can have impacts through policy action, through looking at some of the broader efforts that we can take together to get there. So it's a very tough question. It's important, but it's the way to tackle it may be a little bit different.
Could I jump in there? Because I think net zero is something very different when it comes to scope 1 and 2 and scope 3. So for the oil and gas industry, scope 1 and 2 net zero roadmaps basically means to eliminate all your own emissions of CO2 or methane related to the use of compressors or turbines or leaks. And basically to decarbonize the industry processes related to providing energy. And it's not a small undertaking. It's going to take billions and billions of dollars to invest to make that happen. But I think it was a big announcement that, on Monday, the 12, Chinese, Saudi Aramco, Exxon, Chevron, Petrobras, even with Bolsonaro's, Petrobras for now, supported that, set that ambition. Scope 3 is clearly we have a role to play in helping achieve that, but it's a fundamentally different issue because it speaks to the heart of the matter, basically that, how we are using energy and climate, it's a problem for the commons. And we can play a role in helping our value chain or customers to develop new ways of solving things, meeting the energy needs in different ways. But, it needs a completely different discussion. And that's why I think it's a bit shortcoming, Mike, in your report, because it doesn't address this really fundamental thing. How do we create enabling policy to make that happen faster? Also to investors, I think you should also be looking at how could you help finance crucial steps in this transition, be that carbon capture and storage. How could we get to hydrogen economy faster? Not only rate oil and gas companies, but also how could you commit to invest and provide capital needed to de-risk some of those bold new steps we need to take. So I think there are two different net zero discussions. We're not shying away from any of those, but we have different roles to play. One, clearly we have a much stronger responsibility, the scope 1 and 2 emissions. And we need to remind ourselves, if everybody has fixed their own scope 1 and 2 emissions, the problem would have been solved.
Thanks, Bjorn. We'll turn back to Mike quickly for an additional comment.
Yeah, thanks. I'll probably be quick on this one. Just to echo a couple of the points there, or to clarify, when I say talking about the hallmarks of Paris compliance, that's looking around the company emissions targets in the way that those can be used as a proxy for company action. We're not asserting that it's the oil and gas companies they're not necessarily responsible for those scope 3 emissions. However, those scope 3 emissions are a fundamental part of the oil and gas value chain. Their business model effectively relies on those scope 3 emissions and the end-use combustion. And therefore, if policy action does take us on a low carbon, i.e. low demand pathway, then companies need to be reflecting those scope 3 emissions within their plans. So it's around that and reducing investors' transition risk rather than necessarily attributing blame or responsibility in this context. I think that's the first thing. And yes, of course, we focus from the financial side and looking at the transition risk. Absolutely, there is we need supply side action, but we absolutely need the demand side action too, totally from a policy perspective. And the two will need to go hand in hand for us to solve the climate piece. And I totally echo Bjorn's point there around investors providing capital for new technologies. Ultimately, the energy transition provides a huge growth opportunity for society in general and investors particularly as we move to a sustainable economy in a low carbon world. Thanks.
All right, now we're going to do a quick round in the minutes we have left, starting with Bjorn. Just any further thoughts on the report, or what happens if companies continue to be sanctioning new projects that could become stranded?
I haven't prepared any big, outro bravado here, Carlos, but I think, coming back to this issue that we are in a period now where we would need a fundamental energy transition. One way of looking at that is to see it as a broad industrial transformation. I think actually we could look at that with a negative mindset. So, but I think the more positive mindset that I believe is more promising is ask the question: how could we unlock the capacity and the capital and competence in this industry to make that transition happen faster, and not only look in the rear mirror to see what the reports showed on performance 2 years from now.
Andrew, Tracy?
Sure. I mean, I think we'll just close by saying, thanks for everybody listening. Thanks for Carbon Tracker for continuing to produce these reports. It's hugely insightful analysis for us as institutional investors in our investment decision making, and would encourage other investors that may be listening to continue to seek out resources like Carbon Trackers that are third-party researchers that are specialists in industries like this that are doing investor-oriented research around climate and other ESG issues. It's an essential piece to bringing that to investment decision making, to conversations with companies, to get this specialist data and research, and insert that in the conversation, and broaden the perspective of just company level disclosures and information that you're getting.
Yeah, and just thank you to Carbon Tracker and Carlos and everyone who's listening. There's a lot of change afoot. That's the one thing we all know, that things are changing. So the better we can communicate and understand where we're headed and where we are on the path, the better. I think companies don't often realize that investors really do understand companies that are not able to predict the future, are not able to say what's going to happen, and they're very willing to be partners with companies that are authentic in making this journey. So I think just keep the communication open is key.
Well, I want to give a big thanks to all of our panelists and, of course, Carbon Tracker for hosting us today and bringing us all together. Thank you so much, everyone, for tuning in to today's webinar.
Thanks, everybody.
Thanks, everybody.
Thank you.